So I want to thank everybody for coming today. I'm Lauren Young. I'm the money editor at Reuters, so I don't really dwell in your world so much, except for some of the more consumer-y type of marketplace lenders. And obviously, I deal a lot with banks, but my job is really the pocketbook issues, retirement, saving for college. So if you have any questions about that, I will give you like 1 free minute of financial advice. I want to introduce our panel. What I'm going to do is I'm going to just have the panelists quickly introduce themselves and say what they're doing in this world and while they're here. Scarlett, you want to kick it off?
Sure. Hi, I'm Scarlett Sieber. I'm SVP of Innovation and Ecosystems at BBVA, which really means working with startups and finding cool ways to collaborate and partner. And of course, that's relevant to crowdfinancing because I'm always looking for deals and sourcing them throughout our ventures and business development and digital M&A groups.
Sam Hodges, co-founded and run the U.S. business for Funding Circle, which is a marketplace lender focused exclusively on small business loans. We're currently lending out about $100 million per month. I guess I'm here because we work very closely with banks in both the UK, where we're partnered with Santander and RBS, as well as in the U.S., where we're working with banks on both sides of the market.
Vince Passione, CEO of LendKey. We are a lending as a service platform. Today we have over 320 credit unions and community banks who leverage our platform to deliver an online digital lending experience for their customers. We're servicing over $850 million worth of loans for those clients, and I'm here because of the service that we render to traditional FIs.
My name is Jerry Delaney-Smith. I work for a team called the Credit Suisse Next Fund. We're a $400 million growth equity fund that's affiliated with the Credit Suisse ecosystem. So a lot of the work I do is focused on sourcing and diligencing and providing value to companies that we invest in, which are primarily in the financial technology and services spaces. We've had a lot of activity within the peer-to-peer lending subsector this year. It's been so active and dynamic as part of fintech broadly. So that's one of the reasons why I got affiliated with the event today and recently made investments into both Prosper and SoFi for a couple examples.
Congrats on those investments, by the way. Ram Ahluwalia, co-founder of PeerIQ. We provide risk management tools that help originators and platforms connect to the capital markets.
Thanks, guys. So this panel is banks plus marketplace lenders. 1 + 1 = 3. Now, I am not an investment banker, but I know that 1 + 1 does not equal 3. So one of the things we wanted to ask you, straw poll here, if you look at the Crowdnetic gateway, you see a lot of marketplace lenders that have signed on, right, Luan? How many people in this room are affiliated with a marketplace lender? Please raise your hand. Raise it high, wave, yay. Okay, put them down. How many of you are affiliated with banks? Oh, so there's more bank people than you thought, Scarlett. She's happy. She was really worried that there weren't going to be a lot of bank people in here. All right. Why is this panel 1 + 1 = 3? Who wants to answer that? Who's really good at math? Ram, you're smart.
I'll try to take a crack at this. So there's a lot of talk about peer-to-peer lending disrupting financial services, and certainly that's the case in categories such as payments. But when you look at peer-to-peer lending, what at least I see from my vantage point is, number one, banks are funding the loans directly. So you saw Citibank is buying loans from Lending Club and Prosper to help achieve their CRA requirements. Number two, banks are providing senior secured credit facilities to platforms with the idea of three, securitizing, distributing these products. So I'm not sure I see the disruption story here. I think both parties are working together to create mutual value.
Vince, I knew you were really good at math too. Go ahead.
Yeah, I think what we are is more in an adoption phase of the evolution of a technology disruption, where we had a number of companies who have come out with a very unique technology in order to very quickly and digitally decision and originate loans. But when you look at traditional lenders and you look at the strength of their balance sheets, their cost of funds advantage, the fact that they have been through the cycles before of up cycles and down cycles in credit, it's pretty clear that traditional lenders today are purchasing on these marketplace lending platforms. But as we go out and call on those lenders, what we're hearing is that every single one of them today now has acquired a head of digital customer experience, and it's moving very rapidly to figure out how they maintain their relevance to this customer base. I think what marketplace lenders have demonstrated is that the consumer has voted, and they're not going to go into a branch and wait days for a decision. And now the traditional lenders need to move into that space as quickly as possible if they want to maintain their relevance.
And I think that Rob from Crowdnetic actually highlighted some of the points that I want to discuss, and he did a really, really great job. And historically, we've been using the same type of credit, accessing credit for people for far too long. And with all of these new versions of technology and data sources, it makes it a lot easier for us. And so collaboration is huge from our perspective. And the big things for us is thinking about it in the sense that we now have access or information about our customers that we never had before. And the example about, looking at their credit history on their time on the internet and things like that has been really, really powerful. And also, we see it as another opportunity. There are people we want to go after, and through these marketplace lenders, we have the ability to get access to them in a way that we never could before.
Scarlett, could you tell them a little bit about some of the data you were just telling? We were just standing up here, and she was talking about the innovation being the buzzword that you all just want to go. But it's, there are really interesting things that you find in your daily job. And when you were in Spain, talk about the office and what you're seeing.
Yeah, so our BBVA is a global bank, and our headquarters is in Madrid. We actually have an innovation center, and big data is a huge, huge piece of what we do. And we're kind of big data nerds, and so you walk into our space, and anyone can go in here, and we have on the wall, we have heat maps of payments data and spending data, and all throughout the city of Madrid. It's actually a heat map of Madrid on the ceiling, and you can go and you can see in certain areas at certain times of the day the type of customers that are shopping there and how much money they're spending. So maybe in the areas like Versace and Gucci, between the hours of like 6 and 8 on a Friday, it's really busy. And then at coffee shops, they get a huge influx in the middle of the day from the college students. And so it's something that's pervasive all throughout what we do, and we try to incorporate that in the way that we think about strategy and how we partner with startups.
Hey, Jared, I want you to talk a little bit about what you're getting from each other in this space. So, as a bank, what are you getting from marketplace lenders?
So my perspective, I guess, is a little bit different than some of the others up here, just because, again, I work for a growth equity fund that is affiliated with a large bank ecosystem. We do sit within the Credit Suisse network. And so I think, to answer that question a bit, it seems like in the past year or two, there's been an increase in the level of attention from Credit Suisse and the various divisions across the banks into the peer-to-peer lending space. And I think that's not only because they recognize how large of a disruptor peer-to-peer lending platforms are, broadly speaking, but also because they're recognizing that there's multiple touch points that both parties could benefit from if they establish a cohesive relationship. And so when my fund started to become focused on potential investment opportunities in the space, that was through a lot of the different relationships that were being developed between people from around Credit Suisse and personnel and leadership teams from the various peer-to-peer lending platforms. One example I like to give is earlier this year, we ended up being put in touch with Prosper and ended up leading their most recent capital raise. This was back in April, I believe we closed that one. And when we were examining that as a potential investment opportunity, at Credit Suisse, there were multiple teams at the bank that already had a relationship there. There were obviously our investment bankers who were looking to have them become a client on our investment banking services side. There are securitized product teams that are starting to become involved in the securitization of a lot of these loan products for Prosper and for some of the other ones out there. There was also a products group within our private bank that was examining the potential of creating a product that we could provide to our private banking clients to give them access into these kind of peer-to-peer lending vehicles. So there were multiple touch points that were happening around the bank between CS and a lot of these peer-to-peer lending vehicles. And so for us, we recognize that just speaks to the size of the opportunity and to the fact that entities like Credit Suisse are recognizing there are multiple relationships that could be developed here because of the growth and the dynamic nature of the peer-to-peer lending industry.
That is a perfect segue to my next question, which is where are the opportunities for all of you? And we'll start with Ram, and we'll work our way down the line. Where are the opportunities, Ram, for you?
Sure.
Your business is, a little more.
Yeah, I can describe that a little bit more. I mean, the big theme that you're seeing here is that consumer credit and small business lending is transitioning to the capital markets. What does that mean? It means previously banks would originate and fund loans. However, in a post-Dodd-Frank, post-Basel III, post-Durbin Card Act environment, it's difficult to do so. So non-bank lenders, including marketplace lenders, are stepping in to fill the gap. Now, non-bank lenders must rely on institutional capital to fund these loans. Institutional investors require certain expected rates of returns, and they must in turn fund, and they can't fund via deposits, so they must rely on securitization markets. And that's where we play a role. So what we do is work with prospective ABS sponsors or institutional investors, help them understand and represent the risk across various platforms so they can model out projected cash flows and ultimately secure credit facilities and access the securitization market.
Ron, by the way, is a former fund manager, so he grew up investing in a very different way, and now you've taken some of that skill set, but you're a reformed fund manager,
Yeah,
right?
exactly. Recovering investor,
right.
That's right.
Jared, where are the opportunities for you? Because your portfolio is not just marketplace lenders.
Yeah, so the opportunity for us, from the private equity investor perspective, we have made a couple investments in the space into the traditional lending platforms. I think we continue to maintain a very bullish view on the space from the perspective of the size of the market opportunity, the effective navigation process, if you will, of the kind of changing regulatory environment. It's from a broad investment thesis perspective, I think we remain very bullish. I think we are excited about some of the opportunities that are starting to grow up internationally. I think we're also excited and focused on some opportunities and lending platforms that are focused on different asset classes and the opportunity that's growing there. And we're also now seeing, as the space continues to get more and more institutionalized, there is an opportunity, I think, for a lot of software and services companies growing up around the periphery. Ram's company is a good example, or multiple others that are building. We think what could become very interesting companies that are now servicing this space that's becoming increasingly institutionalized with bigger buyers and more activity and higher volumes.
Vince, you're up.
Sure. The opportunities for LendKey are to continue to build out the platform to support multiple assets. So we started off the business in private student loans, and we're able to get a bunch of financial institutions to get on board to offer those. We then, in 2011, moved into student refinance loans. In 2013, we launched with our energy efficiency program, home improvement, and recently autos. So having multiple asset classes is pretty important, especially when you look at where most of the traditional FIs are focusing, which is that's what they offer today, except they offer them through a siloed approach. So most of the financial institutions we're talking to are looking to create one digital experience across all asset classes. What does that mean? It means the consumer will apply once and have the opportunity to go back and say, great, I saw the rate on that auto loan, and now I want to come back again and get the quote on the home improvement loan. So the opportunities for us are sort of very wide in that we continue to add assets to the system, as well as opening ourselves up to multiple financial institutions over time.
I guess in our case, working with banks really presents two opportunities. The first is on forming more diverse, more permanent, and lower cost capital. And that's particularly true, for banks now who are buying loans directly through us, particularly loans that are on the safer end of the credit spectrum. What that's meant is we actually are in the process of driving down rates for certain borrowers, which over time we think actually will have a really virtuous effect in terms of attracting the best. Moreover, they certainly provide leverage to some of the institutions that are lending to us, particularly on loans that are more kind of in the mid-tier part of the risk spectrum. And in conjunction, that just means more capital for the space and capital that's formed, more cheaply. Secondly, we see working with banks actually, and perhaps the biggest opportunity really is around actually referral of borrowers. This is something that for us first started in the UK. We have Santander and RBS actively sending us many of the borrowers that they either can't or won't serve. And that's something in the UK where the government is actually taking a pretty active role in thinking through, should we mandate actually having bank lenders send these leads to non-bank lenders. In the US, though, we're actually seeing the same thing, even without that regulatory pressure. And I think the reason that's the case is many banks realize that they are not particularly good at doing small business lending. It's expensive, they don't have the technology to do it, the relationship officers are focused on other things, yet they're assiduously focused on keeping those customers. And so rather than risk having that customer go to another bank who might do the loan, or have that customer go to a very aggressive kind of scary lender, one of the kind of Wild Westy ones that we were talking about in the last panel, I think they are very comfortable sending it to a well-reputed small business lender and having us narrowly serve that term lending need.
The opportunities that we see are really international. We have operations in over 30 countries, and while we still see the U.S. by far as the largest market by several multiples, we have a huge presence in Latin America. We're the largest bank in Mexico, and so one thing that we see is with all these influx of other opportunities for lending, underbanked is a big part for us. Underbanked to this percentage that they have no access to capital. It's hard for us to lend money to people that we don't know. And so again, by having partners who can identify these customers, we can build an established relationship with them. You are all of a sudden giving money to people who were unlendable before. And that's amazing, especially given how important Latin America is for our business.
So we talked about the opportunities, and now, of course, we talk about the challenges. The previous panel was talking about small businesses. Are they really fed up with banks, Sam?
So, short answer is yes, and you can measure this a couple different ways. One is if you do if you look at Net Promoter Score data in the U.S. and the U.K., banks are second only to airlines in terms of being the worst. Having flown to New York and coached, I can say that's pretty damn bad. So they're way down there. More seriously, though, when we go out and talk to small business owners, what they really get frustrated with are two things about having to deal with banks. One of which is speed. It oftentimes will take weeks, if not months, to go through a bank application process. And the second thing is the uncertainty around whether they're actually going to get approved. And that has to do with basically kind of the disjointed process that a lot of banks use in actually trying to underwrite small business credit, where you'll have a relationship officer, you'll then have kind of a scorecard process, and then you'll have centralized underwriting, which is why it takes so long. But in the meantime, the business owner is hanging out saying, hey, I want to expand my storefront. Hey, I've got an opportunity to build up inventory. Like, I've got real opportunity cost here. And that's where a digital, first approach, where you can actually deliver a loan, inside of a week, really comes in and delivers a much better borrower experience.
Some of the other challenges, who wants to take a stab?
Well, on the panel before us, one of the gentlemen was talking about banks having zero technology or being the worst for technology. And I was actually going to reference an article which I could not find anywhere. And I think that BBVA is an exception to this rule, but there was an article about a survey around BBVA banks executives globally, and they did a survey about if they knew who OnDeck was, or if they knew who Venmo was, and the numbers were staggering. And so to me, that's a challenge.
Staggering, really,
in a bad way.
But your CEO actually understands what you're doing, right?
Yes, our chairman and CEO is an 80-year-old visionary, but he's definitely the exception to the rule. And so it's easy to get caught up in the hype and all of a sudden start throwing money towards ventures or throwing money towards innovation. But it's a different thing to actually understand what's happening and why that matters. And so making sure that you have a workforce that realizes the problems is extremely important, and a lot of banks don't do that. They hear and they react as opposed to being proactive, which I think, not to say BBVA, but we did that, and I think that we do that.
Ram, talk about some of the risk-related challenges.
Sure. Yeah, I think there are certainly a variety of challenges, especially as institutional investors enter the category. So there are asset liability mismatches. I think that came up a little bit earlier. I'll give you an example. So imagine a hedge fund owns 3 or 5 year paper, but they offer quarterly liquidity to their investors. When the credit cycle turns and defaults start to perk up, you're going to see increased redemptions on that hedge fund, and they have no liquidity on these loans. Therefore, that creates an asset liability mismatch, and that's not going to end well unless you create the appropriate infrastructure to support the category. So the infrastructure you expect with a traditional fixed income asset class includes trade settlement, confirmations, back office, and the promise or access to liquidity in different ways, hedging instruments, credit risk analytics, net asset value pricing. So all of that needs to get built for this category, and I think the level of institutional investment has gotten ahead of the needed infrastructure, and so we and other players are working to help build that out.
You want to add anything to the list, Vince, or you want me to go to the next question?
No, I think the last piece on our experience and some of the friction points that we see in dealing with traditional banks is the integration piece, that they recognize they want to be quick and get into the market, but at the same time they want to integrate into some of their legacy systems. Examples would be from the treasury perspective or the servicing perspective. And although as a former CTO of Citigroup, I would say that Citigroup certainly has the technology and know-how to build a platform like this. The question isn't can they build it? The question is, can they deliver it in a timely fashion? Because when they start to go through the appropriations process and they need to go through those reviews, as we said earlier, one thing they all hold in common is they recognize that they need to create one digital experience across all asset classes. Citigroup and most banks are not organized that way, right? The mortgage people do not talk to the auto people, do not talk to the credit card people. These are all separate P&Ls. So the idea sounds great when you meet the head of digital experience for one of these banks or the head of global consumer, but that person really is empowered to make the yes decision. So those are some of the friction points which elongate our sales cycle. But we're starting to break through, which we think is a big opportunity.
Is there anything you want to add, Jared, or you want me to go to the next question? Because I'm happy to.
I mean, there's one point I'd make, I guess, that I've noticed as I've been meeting with a lot of the startup companies in the space, especially a lot of the companies that are earlier stage and pure technology companies that are trying to penetrate this peer-to-peer lending industry and then also establish relationships with the banks. I think I've seen a little bit of a challenge with some that are, particularly on the earlier stage, and don't maybe have the built-out risk departments and infrastructure or people on the team, especially in the senior management team, with the experience at traditional lenders. They may not have a staff of people that were previously at Wells Fargo or Capital One, or have these established teams of people that have been in the lending space for a number of years. I think potentially some of those startups that are, especially on the technology side, without that, sometimes have issues getting the right audiences in the room at many of these banks. We as kind of a third-party fund are able to function a little bit separately from the Credit Suisse ecosystem, but I am seeing that as a recurring theme with some of the smaller companies in the space trying to get in front of a Credit Suisse or any of the larger banks out there.
If I can add to that, I don't think it's just credit, although I very much agree that the credit and risk analytics is a really key piece of it, and it's the central point when we've talked to banks. But even beyond that, and this is part of the reason banks have lots of strictures, they have compliance requirements, information security requirements, there's general policy requirements that non-bank lenders don't have to deal with. And so one of the kind of counterintuitive things about having marketplace lenders partner up with banks is, of the policies banks have, what do you need to accept in order to get that partnership to work versus what can you kind of push off and say, only the bank has to deal with that. And navigating that has actually been, for us, one of the harder things. Just takes time, though.
Can you guys talk about some of the notable collaborations that you've seen? I mean, I don't expect that you're going to say really amazingly great versus amazingly really bad, but what are the collaborations out there that you're seeing right now that are interesting and why?
Well, we announced one earlier this year, and that was Apollo Global Management when they stepped in and decided that they wanted to structure a forward flow arrangement with some of our credit union clients. Credit unions tend to be a lot smaller from a balance sheet perspective, and most of our credit unions have been originating student refi loans since 2011. Based on the risk-based capital rules that they have, they're starting to get all full up, where they can't originate any more of these loans on their current balance sheets. Apollo took a look at the credit quality of what they were originating and stepped up and made $1 billion commitment to purchase those loans going forward. So what they did something was very unique. They almost created a Fannie Mae, if you would, for student refi loans, expanding the balance sheet of these lenders so they can continue to turn around and originate in their name, maintain the customer relationship, and sell a very specific loan to an institutional buyer who has no intention of working with that client. That borrower is strictly a financial buyer. So we've been at it since February. We think that particular forward flow is also replicable across other asset classes like home improvement loans and other point-of-sale loans.
Vince, who's your typical customer? Can you just give a little quick snapshot?
Sure. On the credit union side, it's usually about a $350 million asseted credit union. On the banking side today, although Navy Federal is our largest, they're a $65 billion credit union. On the banking side, WSFS Bank in Delaware, they're about a $5 billion bank. But in the last 6-7 months, what we've seen is that in our pipeline are super regionals and one very large major money center bank. They're moving pretty rapidly down the path of delivering a fully digital online lending experience for their clients.
And for the people whose loans you're refinancing, what's their snapshot?
So typical refi for our client is about a 735 FICO score, average income about $75,000.
So that's everybody in the room plus.
Yeah. If you look at our clients, I mean, if you look at some of the more notorious lenders in the refi space, the SoFis of the world, if you talk to Mike, he will tell you that he goes after the Henrys, right? The highly educated, not rich yet. If you take a look at what our clients are doing, they're going after their current client base, right? The average FICO in the United States is probably about 680. If you look at the average FICO for a credit union client, it's about 690. The same for community bank. And that's what these lenders are doing. Their cost of funds are extremely low at 50 basis points, so they can make it work for a prime customer. They don't need to give up much in the securitization because they'll balance sheet these loans.
Sam, I know you talked a little bit about this before, but who's your typical customer?
So our average borrower in the U.S. is a small business that has been around for 8 years, that has roughly $2 million in revenue, that's profitable, and where the individual behind the business has slightly north of 700 FICO score, and where they're looking for about $140,000 in order to expand. So it's very much kind of a prime, core, smaller commercial entity.
And I was spying on your website, 10 to 20 employees, is that what it is?
Yeah, average is about 15 in terms
50,
of employee.
wow,
No,
okay.
1.5, sorry.
Okay, 1.5,
In terms
15.
of employee.
Okay, yeah, so that's between 10 and 20. Is that, see, we're so good at math here. 1 plus 1 equals
It's a math
3.
lesson.
Metrics. So one of the, obviously, to make anybody successful, rich, and really good at math, you have to have metrics that you can evaluate whatever it is that you're looking at. What metrics are you using, and which ones are valuable to you? And Ram, I think I'll kick off with you because you're the data dude.
I'm the data dude. Okay.
Data dude.
Well, so the metrics from the perspective of an institutional investor, or what vantage point? You're looking
I think for you, from the institutional investor. But if there's any other numbers you want to throw out there to
Sure,
make everybody
sure.
feel dazzled, go for it.
So investors have certain return, risk, liquidity, duration requirements. So what they'll do is look at what a risk-adjusted return will look like. And that's extremely difficult to do for this asset class. Well, why is that? Imagine you originate a loan on Lending Club or Prosper and it has a 3-year life. The weighted average life on that loan, because of prepayments, could actually be 1.5 years. So the stated coupon on the loan does not correspond to the effective yield on the loan. And if you're managing a portfolio of hundreds of thousands of loans, it's very difficult to understand without credit risk analytics how to evaluate a portfolio. So some of the metrics that investors will look at will be the projected or model yield based on an assumption of prepayments and defaults for cohorts within the loan population. They'll also look at historical vintages of credit risk and prepayment behavior. They'll look at the weighted average life of the loan. They'll look at the seasoning of the loan as well. What are the geographic concentrations? Are the rates or coupons bumping up against potential state usury laws or other types of regulatory considerations?
Jared, you're looking at all different kinds of companies to invest in. Specifically with marketplace lenders, what are the metrics that you're looking at?
Yeah, I mean, it's for us. I don't think any of this will come as a massive surprise to the folks in the room. But from the private equity perspective, the stuff that we're most focused on is, of course, growth. At the end of the day, it's particularly growth around originations. We recognize that depending upon how the models are developed, there's a different take rate on all these types of companies. So depending upon the asset class you focus on or the way that you're going about servicing the loans, if that's the area you focus on, there's a different amount that actually comes home in revenue. So we do like to see it's a discernible growth on the origination side.
Double-digit growth or single-digit growth, or is it really?
Double-digit would be nice.
Okay, yeah, obviously. But I mean, go ahead.
I mean, it's tough to necessarily put a number on it because
But I'm trying to get you to.
Yeah, there's a lot of earlier stage companies that are coming from low bases. So there's a massive amount of growth from these companies and a little bit less on a percentage basis for some of the bigger guys. But we also like to see a combination of some healthy growth metric depending upon where you're at, in addition to attractive economics with the particular asset classes that you're focused on. And so with our investments in Prosper, it's a consumer-oriented lending business. SoFi, our other recent investment, is more focused on the student loan space, but now moving out into other product classes. And with the increase in the product mix, there's a little bit of a change in the economics there. So depending upon what asset class they're focused on, the economics behind those loan arrangements are another figure that we focus on quite a bit.
Sam, for you, as the person who's running a business, what are you looking for?
Well, I guess I separate what we look for in a borrower versus what we track within the business.
Okay, great.
In terms of what we look for in a borrower, I mean, we're crunching a lot of data, as I think all digital SME lenders are. At the end of the day, most of it boils down to what's the debt service coverage level and what's the loss given default and what level of volatility would we expect in that, as you move through a cycle, and therefore how do you need to price the loans so that a reasonably diversified portfolio of these loans will actually perform well even as you move into a down cycle. That's basically how our pricing works. A lot of data science goes into exactly how we tweak the different pieces of that, but that's the fundamental math. In terms of actually running the business, for us, it's all about profitable origination. And then it's also about stability of my revenue sources. Our revenue basically comes from origination fees and also servicing fees. So we have some recurring piece and some upfront piece, making sure that we got the right balance between those two so the business is sustainable, even if we have to slow down origination growth at some point, although we certainly aren't doing that now. That's a big piece of it as well.
Cool. Question for you, Scarlett. Banks, as everyone in this room knows, don't have a great rap when it comes to being revolutionary and innovative. So where do you think there's a common ground with marketplace lenders who are doing really innovative stuff?
I think it comes back to collaboration, which is a word that we really overuse, but we as a bank, or as banks as a whole, I can't speak on behalf of every bank, but I can speak on behalf of ours. We know our areas of strength and weakness, and one of you said this earlier, it comes down to timing too. You already have your customer base, you have them in a way that we can't, and so I think that's where there is a balance. We have things we can provide you. We actually invested, I think the public number is $400 million redoing our core processing system to try to get rid of the legacy to make sure that we can support you and have a strong back end. So it becomes a reciprocal relationship. There's a lot that you can provide us, and I think that we have a lot that we can provide you as well.
Anybody want to add to the common ground that you have? Vince, why not you, since I didn't ask you last time?
Common ground?
The common ground between marketplace lenders and, well, for you, it's credit unions / banks.
Mm-hmm. Yeah, no, look, I think I use the word collaboration, I use the word adoption, right? That what's going to happen is there's just going to be a wholesale adoption of the technology. We've seen this cycle before, whether it was looking at bill payment or looking at screen scrapers back in the past, that companies form around the technology, they demonstrate the technology works, they act as the canary in the coal mine for the regulators, they pass the regulatory test, and then what happens to most of these very large, sophisticated financial institutions is they will adopt that technology. So I think part of the common ground is going to just be a wholesale adoption of the technology. Part of it will also be over time that from a customer acquisition perspective, the survivors, right, the large marketplace lenders that will survive, will turn around and continue to demonstrate their ability to acquire customers very cheaply, and we will see traditional FIs to continue, based on their cost of funds advantage, to sit on the back of those platforms and to continue to purchase those loans.
Great. So we're getting towards the end of the panel, but obviously for banks, one of the major things is interest rates, right? And one thing we haven't seen before, Vince, for this industry is a rising rate environment. What does a rising rate environment mean for you and for the world of marketplace lending? I think we know what it means for banks, but feel free to talk about that too.
So we first start with the natural one, right? In a rising rate environment, the borrowers lose and savers win, right? That's typically what happens.
Woohoo!
If we look at what's going to happen here, the first thing is, and people have been talking about it all day, is in a rising rate environment, what is going to happen to the consumer? Delinquencies are going to spike. Will they spike like they did in the last downturn? Probably not. The consumer is in much better shape, right? They've cleaned up their balance sheets. So delinquencies will spike, but probably not as bad as they did in the past. The other is other investments will show up for institutional buyers. So we'll see some of the supply that's currently out there that's on the back of these marketplace sites start to dry up as those institutional investors find other investments over time to invest in. So we'll see some thinning, right, on the demand side and on the supply side. We're also going to see a test, right, a test of the underwriting. We've heard a lot of discussion about alternative data or uses of alternative data, and the question is it working? And the best way to find out if it's working or not is to stress the portfolio. So we will see a live stress occur, and then certainly we'll see some hypotheses be proven true and some be proven false about whether or not these platforms are truly working as designed.
Ram, talk about the world of securitization in a rising rate environment. In plain English, please.
Sure. So
I just didn't want to freak you out with all sorts of weird derivatives.
Sure. So I think to presage that answer, I'll start by saying I think the more relevant risk factor is what happens when the credit cycle turns. If there's a rising rate environment, I think you'll see that additional risk premium built into the cost of a loan. And rising rate environments are typically accompanied by periods of robust economic growth. However, when the credit cycle turns, then the behavior of investors and the loss performance on the pools are where you'll want to focus. Today, with marketplace lenders, there's no obligation for institutional investors to purchase loans day in and day out. They can choose to change their mind if loss-adjusted performance does not conform to their expectations. The way securitization, I think, will play an important role in helping to address this challenge is by enabling ABS issuers that buy these loans, or essentially the institutional investors that buy loans on the platforms, helping them to access securitization market, which is a source of non-recourse termed out financing. And it's interesting, if you look at the 10Ks of the major non-banks, in their risk factors, they'll identify risk factors including, we rely on the ABS market to fund our business. So the large marketplace platforms that we work with today are saying, hey, help us diversify our cost of capital, diversify our funding sources, reduce our cost of capital, and help us build a bridge to the capital markets that's repeatable and accessible in a stressed credit environment.
Great. I am going to say that we're almost done. So is there anything, I have one last question for you, but is there anything you guys didn't get a chance to say that you really want to say before I see somebody had a question? Were you raising your hand? You're just stretching. What inning would you say we are in for your businesses? Just go down the line. Scarlett, where are we for you?
Yeah, I would say very early, second.
Oh, by the way, Scarlett, hello, just got engaged too, for everyone who's getting engaged in the room. And he did it scuba diving. Mazel tov, Scarlett. Sam?
Second.
Yeah, I'd say second as well. We're very early days here.
Jared?
I would say either the first or the second inning.
But you're wearing the Yankee pinstripes, so you could be later.
But I'm from Boston originally, so I'm not going to take offense.
No, you won't.
Agreed, first or second. Early
Sam?
days.
Early? Great. I want to thank our panelists, and everyone, can you please give them a very loud round of applause?